So this is the 1st of September presentation. So we'll cover who we are, what we do, how we've done, and how we do it. And in that section we will deal with a case study on North American chicken producers. So who we are. FVCA Advisors is a South African domiciled investment advisor, and the business is 2 years old. We serve one client, an investment manager based in Bermuda, and we provide them with investment advisory services for one of their funds, which is called the FVCA Endurance Fund. And this is domiciled in the Cayman Islands. It's a dollar-denominated equity long-short fund. The fund itself started a few months after the business in November 2014, has assets under management of $11.4 million and is run by 3 founding partners with the support of an office manager. This is just a graphic representation of what we've just been saying. This is the sub-advisor, FVCA Advisors, and this is where the fund is housed in the Cayman Islands. This is the Bermudan domiciled manager that FVCA Advisors provides services to, and this entity is just a pass-through entity. These are the 3 partners, myself, Mike Kane, who served as head of consulting for Ernst & Young for many years, and plays the role of Chief Operating Officer for the business, and Mike Stredfield, who worked at Investec as head of quants for many years and performs the role of head of research. This is just more detail on the 3 of us, and don't propose to go through it in great detail, but if you want to go through it, you'll find this on our website. So, what we do, this is the investment philosophy of the fund. We seek to generate excess returns by exploiting the enduring inefficiency of capital markets. And these returns are in excess of what one could achieve by taking on greater risk of permanent loss. The reason why we believe that the market offers this inefficiency is because participants are irrational, and that irrationality is demonstrated in 2 ways. One, through short time horizons, and 2 would be through overconfidence. So we are also prone to these failings, and as a result what we focus on is processes which seek to counteract these same tendencies that we would have by virtue of being human. In terms of the fund, it's a flexible investment vehicle or hedge fund. As you said, it's based in the Cayman Islands. It employs a classical global equity long-short strategy focused on public regulated exchanges. The fund invests in parts of the capital structure which may offer equity-like returns. So equities, can invest in the debt, convertible instruments, and in derivatives. And the fund also uses leverage. So it has a gross exposure limit of 150%, and this translates into being 100% long and 50% short when opportunities are abundant. The individual exposure limits are 5% for long positions and 2.5% for short positions. The objective of the fund is to compound capital at 10% per annum in dollars over meaningful periods, and that's on a net of all fees and costs basis. So how have we done? This reflects the return profile since inception. This is the 1st of November 2014, and the fund has returned 4.23% since then. If one looks at just the year to date, so since January 2016 to the end of July, the fund has returned 5.6%. So that 5.6% compares quite well with -2% for funds globally that follow the same strategy, or sort of a flat return for all hedge funds globally. Certain other strategies have done better than the -2% or the 0, but the MSCI World has beaten all of them with a return of 3.5%, and the S&P 500 has returned 6.3%. So that 5.61% at a 40% net equity exposure is what should be compared with the 6.34% at 100% exposure. This is our exposure summary. This section of the graph represents the long positions, and this section below represents the short positions, with the line indicating the net equity exposure. And as you'll see, if we go to the 1st of January, the fund has roughly run at about an average 40% exposure during the course of this year. So just expanding on that, this return is the return of the S&P 500 with 100% market exposure by definition. This is the return of the fund with 40% market exposure. These lines represent a stylistic representation of what returns would have been achieved if exposure had altered. So the S&P 500, 40% exposure to the S&P 500 would only have returned 2.5%. And this is exactly what the fund is seeking to do, which is to deliver higher rates of return for commensurate levels of risk exposure. So how have we done it? So we follow a process which has a few steps. The first is prospecting, and there's evaluation of these ideas. There is, we then move into a risk-informed way of taking exposure to the idea, and we focus on ongoing monitoring of those positions as time goes by. And the case study that we will use to just illustrate this is the US chicken stock case study. So this is a FVC screening app. We use this tool to evaluate a large pool of potential targets, and we sift them. So in this case, the horizontal axis is PE, or the price earnings ratio, and goes from 5 to 25. And the vertical axis ranks these targets according to something called the combined return on assets and inverted PE rank. And what you'll see highlighted here is a company called Sanderson Farms, which has a very low PE, so a PE of, let's call it 6, but yet has quite a high return on assets, as implied by this combined return on assets and inverted PE rank. So it ranks 320, sort of a score of 322. This color, the green color, implies that there's quite a significant short interest ratio in this company, or there was at the time that the screen was run, and that was quite interesting and or puzzling for us, because we thought, wow, cheap company, high return on assets, why would market participants be so negative on it? At the same time, there was another chicken producer called Pilgrim's Pride, similarly positioned, so low PE, PE of 7, relatively high rank of 260 for the combined return on assets and inverted PE rank, with significant short position of about 20%. This graph gives you some idea as to why those short positions were in place. So this is Sanderson Farms' operating margin history, and from it you can see that these businesses are very cyclical. Their operating margins bounce around from highs of over 10% to lows of -10%. They don't earn smooth profits. So despite bouncing around, the average for this business is about a 6% operating margin, and most recently, or at the time that we were running our evaluation, this company had achieved an operating margin of 15%, and that was where the negativity was coming from, in that certain market participants were betting that in fact operating margins were going to do what they've done in the past, which is plunge. We looked at an analysis of the impact of scale on normal margin expectations for Sanderson Farms, and what that was basically telling us was that given how the business had grown from 2005 to 2015 in terms of revenue and scale, they really should be earning a normal margin of about 8%, but they were earning a margin of 15%. This is Pilgrim's Pride. You'll see that they spent a lot more time earning negative margins, and their average margin was a lot lower, but at this point in time of evaluation, they were sitting at an even higher operating margin than Sanderson Farms, and once again, that's where all the negative bets were coming from. All the shorts were effectively betting that this operating margin was going to plunge, and that the share price would plunge commensurately. So what we did was we then said, well, we are interested in valuation, or what these companies are worth. So this is Sanderson Farms, and we conducted a scenario analysis where we said just focus on the average column at the average operating margin of 5.7%, and at the 10-year average nominal average revenue that the business achieved, the business would be worth $50, assuming sort of historic growth rates and free cash flow conversion. In the case of Pilgrim's Pride, similarly, if all they could achieve was a 3.5% operating margin and average revenue over the last 10 years, then they were really only worth $8.6 on certain growth and free cash flow conversion assumptions based on their history. Bearing in mind what I said earlier on about the 8% margin, we effectively concluded that the fair margin for Sanderson was 8%, and we were happy to give Pilgrim's Pride the benefit of the doubt, also using an 8% margin, and on that basis we came up with these fair value assessments for the two businesses: $98 for Sanderson and $31 for Pilgrim's Pride. You can ignore this. This is a business called Tyson, and we really looked at it for comparison purposes when we were evaluating these two chicken producers, because Tyson is a broader producer of protein foods. We then went into assessing the risk of these businesses, and this is a graph of what happened to the shares in issue over the last 10 years. And as you'll see, Pilgrim's Pride has issued a lot of shares, which has obviously been pretty dilutive for their shareholders, or would have been, and Sanderson's been very disciplined, not really issuing much in the way of shares over that period. So just on this basis, we would prefer the flat line and not the growing line as shareholders. As a result, we invested in Sanderson Farms. This is another application that we use at FVC Advisors. It's called the FVC Fair Value Explorer, and it effectively tracks our positions. The red line indicates what our fair value assessment is, and the blue line is the actual share price of the business. We invested in this business, sold it on the 1st of March because it really didn't offer much upside at that point, whereas on the 1st of March, Pilgrim's Pride, which we had not initially invested in, actually offered more return potential. Here you'll see the ongoing monitoring analysis on the 1st of March. Sanderson had already delivered a return of 36% from our initial assessment, only offered 7.6%, but Pilgrim's Pride still offered another 28%, and hence our decision to sell Sanderson and invest in Pilgrim's Pride. these are excerpts from our trade log. It indicates what I've just been saying. But in the aggregate, what it indicates is that we invested $207,000 into Sanderson, liquidated that investment on the 1st of March, invested the proceeds into Pilgrim's Pride and liquidated that investment in early May, yielding a total return of $100,000 over 239 days, or a return of 48% or 74% annualized. So obviously not all ideas work out this way. I think the main point of the discussion was just to demonstrate the process of prospecting, evaluation, risk-informed exposure, and ongoing monitoring, and how that played out in one particular example, which were these US chicken stocks. Important to note that this is not an invitation to invest or to indeed replicate the ideas discussed. And I'd like to take an opportunity to encourage you to visit our website, find out more about what we do. You can also access the library there, where you'll find publications that we release quarterly, as well as fact sheets. Many of you probably do already receive our communication, but please feel free to visit the website.